The year is 1971. In a dimly lit room at Camp David, President Richard Nixon sits across from his advisors, chain-smoking, sweating through his shirt despite the air conditioning. Outside, protesters demand answers about Vietnam. Inside, Nixon is about to make a decision that will alter the relationship between money and power forever. He leans forward, ash from his cigarette falling onto the briefing papers, and says the words that will echo through every dollar you've ever earned. We're closing the gold window. Just like that, with no congressional approval, no public referendum, no grand ceremony, the United States severs the final link between the dollar and gold. The Bretton Woods system, the monetary order that rebuilt the world after war, dies in a weekend meeting. And in that moment, something profound happens. Money becomes nothing more than an idea, a promise printed on paper, its value determined not by what backs it, but by who controls it. This isn't the story of an economic accident. This is the story of how inflation became the most elegant form of taxation ever devised, a silent transfer of wealth so subtle that most people never realize they're being robbed. This is about why your dollar buys less each year, why your parents could afford a house on a single income while you juggle 3 jobs, why the distance between the wealthy and everyone else grows wider no matter which party holds power. And the most disturbing part? It was always the plan. Here's the question that should keep you awake at night. What if inflation isn't a policy failure, but a policy feature? What if the steady erosion of your purchasing power isn't an unfortunate side effect of complex economics, but the entire point? Because when you understand who benefits from inflation and who pays for it, you start to see the modern economy not as a neutral system of exchange, but as a carefully orchestrated transfer mechanism, moving wealth upward while convincing the middle class that their struggles are somehow their own fault. This isn't conspiracy. This is monetary policy laid bare, stripped of its academic jargon and institutional obfuscation. This is the story of how governments learned to fund themselves without ever asking permission, how central banks became the most powerful unelected institutions in human history, and how a generation was sacrificed on the altar of financial stability that never actually arrived. To understand why we're here, you have to go back to a world that seems almost unimaginable now. For thousands of years, money meant something physical, something you could hold, something that couldn't simply be created by decree. Gold, silver, commodities with inherent scarcity. When kings wanted to fund wars or palaces, they had 2 options: tax their subjects directly, which risked rebellion, or debase the currency, shaving gold off coins or mixing in cheaper metals. But there was a limit. You could only debase so much before people noticed, before merchants started refusing the currency, before the whole system collapsed. This constraint, this physical reality, acted as a brake on government power. You couldn't simply wish wealth into existence. Every coin represented real resources, real labor, real constraints. Then came paper money, initially just receipts for gold stored in vaults. These notes circulated because everyone knew they could be redeemed for something real. The promise was simple: bring this paper to the bank, get your gold. This system required discipline. If you printed more notes than you had gold, you were committing fraud. Banks that did this collapsed. Governments that did this faced runs on their reserves, losing credibility and power. The gold standard wasn't perfect. It created its own problems, but it had one undeniable feature. It limited what governments could do. They couldn't fund unlimited programs, couldn't fight endless wars, couldn't promise everything to everyone. The money supply was anchored to something finite. World War I shattered this system. When nations needed to mobilize total war economies, when they needed to move millions of men and manufacture billions of bullets, the gold standard became an obstacle. Britain, France, Germany, they all suspended gold convertibility to fund the slaughter. Print money, arm soldiers, win wars. After the war, they tried to go back, try to restore the old order, but it was like trying to put a genie back in a bottle. The 1920s saw chaotic attempts to return to gold, culminating in Britain's disastrous decision to restore the pound at its pre-war gold parity despite the currency being fundamentally overvalued. This created deflation, unemployment, and social unrest. Then came the Great Depression, and with it, the intellectual ammunition to abandon gold entirely for domestic policy. When people are starving and banks are failing, arguing for monetary constraint seems cruel, almost monstrous. Franklin Roosevelt confiscated private gold holdings in 1933, forcing Americans to trade their gold for paper dollars at $20.67 per ounce, then immediately revalued gold to $35 per ounce. This wasn't monetary policy. This was a 40% devaluation overnight, a massive transfer of wealth from citizens to the government. But it was sold as salvation, as the necessary medicine to cure economic depression. And people, desperate for solutions, accepted it. After World War II, the victors designed a new system at Bretton Woods. The dollar would be convertible to gold at $35 per ounce, and other currencies would peg to the dollar. America, holding the majority of the world's gold reserves, became the anchor of global finance. This system worked for a while. It required discipline from the United States, a commitment to maintaining the dollar's value, to limiting money creation. But discipline erodes when temptation grows. In the 1960s, America wanted everything. Social programs through the Great Society, a war in Vietnam, technological supremacy in the space race, global military dominance. These ambitions required money, more money than tax revenues could provide without political cost. So the printing presses ran. Dollars flooded the world. More dollars than America had gold to back them. Foreign governments noticed. France, under Charles de Gaulle, began demanding gold for dollars, sending warships to New York to physically retrieve their bullion. This was a run on the bank, slow motion but inexorable. By 1971, Nixon faced a choice: admit bankruptcy, confess that America had printed more promises than it could keep, or change the rules entirely. He chose the latter. The Nixon shock wasn't presented as revolutionary. It was framed as temporary, a brief suspension to deal with currency speculators. We'll return to gold convertibility once things stabilize, the administration promised. That return never came. Instead, the world stumbled into a new monetary reality: fiat currency, money backed by nothing except government decree and institutional trust. This was the moment everything changed. Without gold convertibility, there was no external limit on money creation. Central banks could print as much as they wanted, whenever they wanted, constrained only by political will and fear of inflation. And here's where the story gets interesting, because the people in charge quickly learned something profound. You can get away with a lot more inflation than classical economics said was possible, especially if you control how it's measured and how it's discussed. The 1970s were chaotic, stagflation bewildering economists who believed inflation and unemployment couldn't coexist. Oil shocks, monetary mismanagement, and collapsing confidence created an era of economic despair. But rather than returning to monetary constraint, rather than admitting the fiat experiment had failed, the establishment doubled down. They needed to solve inflation without giving up the power to create money. The solution was Paul Volcker, appointed Federal Reserve Chairman in 1979, who jacked interest rates to levels that crushed the economy but killed inflation. This brutal medicine worked in its way. Inflation fell. Volcker became a hero to creditors and bondholders. But the deeper lesson absorbed by those in power was different. Inflation could be managed, controlled, kept within acceptable bounds while still allowing unprecedented monetary expansion. All you needed was credibility, institutions people trusted, and a willingness to sacrifice workers when inflation got too high. Since Volcker, we've lived in an era where central banks claim to target roughly 2% inflation annually. This number, 2%, is treated as scientific, as if it emerges from some fundamental economic law. It doesn't. It's arbitrary, a political choice dressed up as technical necessity. And here's what 2% inflation means in practice. Your money loses half its value every 35 years. $1 in 1971 is worth about 17 cents today. This is an accident. This isn't policy failure. This is the system working exactly as designed, Because inflation serves crucial functions for governments and those closest to power, even as it quietly destroys the middle class. If stories like this fascinate you, consider leaving a like. It helps bring more hidden chapters of economic history to light. Think about who benefits from inflation. First, and most obviously, debtors benefit at the expense of creditors. When you borrow money and pay it back later with devalued currency, you're paying back less in real terms than you borrowed. For individuals drowning in credit card debt, this might sound appealing, but the biggest debtor of all is the government. The United States carries over $30 trillion in debt, a number so vast it defies comprehension. Paying this back with honestly valued currency is impossible. But paying it back with continuously devalued currency? That's the strategy. Every year inflation runs above the interest rate on government bonds. The real value of that debt shrinks. This is how governments default without admitting default. They print money, create inflation, and watch their debt burden melt away while bondholders and savers get quietly robbed. Second, inflation benefits those closest to the money printer, a phenomenon economists call the Cantillon effect after Richard Cantillon, who described it in the 1730s. When new money enters the economy, it doesn't distribute evenly. It enters through specific channels: government spending, bank lending, asset purchases by central banks. Those who receive this money first, before prices adjust, can spend it at yesterday's prices. They get the full benefit. By the time this money circulates through the economy, by the time it reaches workers and savers, prices have already risen. The people furthest from the money printer get devalued currency and higher costs. This is why asset prices, stocks, real estate, art, explode during periods of monetary expansion while wages stagnate. The wealthy own assets. The middle class owns labor. Inflation benefits the former and punishes the latter. Third, inflation obscures political choices. When governments fund programs through taxation, citizens see the cost directly. Every tax increase becomes a political battle, forcing politicians to justify expenditures and prioritize among competing demands. But funding through inflation is invisible, immediate, and requires no legislative approval. The central bank simply creates money, the government spends it, and by the time inflation appears, the connection between money creation and price increases has been obscured by time and complexity. Politicians can blame corporations for raising prices, blame foreign oil producers, blame supply chains, anything except their own monetary policy. This allows for massive government expansion without the political cost of taxation. Look at the last few years. In response to COVID, the United States created roughly $5 trillion in new money, an unprecedented expansion of the monetary base. This money funded stimulus checks, unemployment benefits, business loans, creating a brief illusion of consequence-free generosity. But that money didn't create new goods or services. It didn't build factories or train workers. It simply chased the existing supply of products with more dollars, inevitably creating inflation. When prices surged, the response from those who created the inflation was to blame everyone except themselves. Greedy corporations, they said. Supply chain disruptions. Putin's war. Anything but the trillions of newly created dollars flooding the economy. And much of the public believed these explanations, because understanding monetary policy requires education that most people never receive by design. Here's where it gets even darker. The way inflation is measured has been systematically manipulated to understate its true impact. The Consumer Price Index, the official measure of inflation, has been revised repeatedly over decades, always in ways that lower the reported number. In the 1980s, the government began using substitution in its calculations. If steak gets too expensive, they assume you'll buy chicken instead, and they measure the price of chicken rather than admitting steak became unaffordable. This isn't measuring inflation. This is measuring the declining standard of living required to maintain the same CPI number. They introduced hedonic adjustments, claiming that products are better now than before. So even if the price rises, you're getting more value. Your computer is faster, so the price increase doesn't count as much. Your car has more features, so that price increase is discounted. Never mind that you can't choose to buy the 1990 version at 1990 prices. These adjustments systematically understate inflation, which serves multiple purposes. It reduces cost of living increases for Social Security and government pensions. It makes economic growth appear higher in real terms. And it allows policymakers to claim inflation is under control even as ordinary people feel squeezed by rising costs. Some economists estimate that if inflation were measured using 1980s methodology, the real rate would be double the official numbers. Your gut feeling that prices are rising faster than the government claims? You're right. But the true cost of inflation isn't captured in any index. It's the erosion of trust, the fraying of social bonds that happens when people work harder and fall further behind. In the 1960s, a single income could support a family, buy a house, save for retirement. This wasn't because people worked harder then. It was because money held its value. A dollar saved was a dollar later. Today, saving money in a bank account means losing purchasing power every year. The interest rate on savings is virtually always below the inflation rate, guaranteeing negative real returns. This forces people into financial markets, into stocks and real estate and cryptocurrencies, chasing returns just to maintain their purchasing power. This benefits Wall Street, which collects fees on every transaction, every managed fund, every complex financial product. It forces ordinary people to become speculators just to avoid being robbed by inflation. And when those speculations fail, when markets crash, the losses fall on individuals while the gains were privatized. Meanwhile, those who can't afford to speculate, who live paycheck to paycheck with nothing left to invest, they simply get poorer in real terms every year. Consider housing, the clearest expression of monetary inflation's impact. In 1971, the median home price in America was roughly $25,000. Today it's over $400,000. Wages have not increased 16-fold. This isn't because we've run out of land or because houses are 16 times better. This is monetary inflation expressing itself through the asset most people need to build wealth. Young people today face a choice their parents never confronted. Go deeply into debt to buy property, gambling that inflation will continue to push prices higher, or rent forever, watching potential equity evaporate into landlord profits. This isn't a housing crisis. This is a monetary crisis manifesting as a housing crisis. And the solution offered by policymakers? More lending, lower interest rates, programs that put more money into the system without creating more houses. This drives prices higher still, benefiting current owners and devastating aspiring buyers. Inflation doesn't just redistribute wealth from poor to rich. It redistributes opportunity from young to old, from future generations to present beneficiaries. The psychological impact runs even deeper. Inflation creates a culture of immediate consumption over delayed gratification. Why save when your savings lose value? Why plan for the future when the future is uncertain and your money will be worth less? This short-term thinking, this erosion of the ability to save and invest in your own future, it damages societies in ways that never appear in economic statistics. It undermines the virtues of thrift, patience, and careful planning that built prosperous middle classes. It replaces them with debt, speculation, and the desperate hope that asset prices will keep rising forever. And when crashes come, as they inevitably do, those who own nothing lose nothing on paper, but lose everything in opportunity. Those who own assets see paper losses but maintain their relative position. The game is rigged, and inflation is one of the primary rigging mechanisms. Now, consider the political economy of central banking. The Federal Reserve, like most central banks, is technically independent from direct political control. This is sold as necessary for sound monetary policy, preventing politicians from printing money to fund election promises. But independence from voters doesn't mean independence from power. Look at who runs central banks. Former investment bankers, academic economists funded by financial institutions, policymakers rotating between Treasury departments and Wall Street firms. The revolving door between financial power and monetary authority is well documented. These aren't conspiracies. These are institutional incentives. When Fed governors know their next job might be at Goldman Sachs, when their peers and friends are financial executives, when their worldview is shaped by the same institutions that benefit from monetary expansion, is it any surprise that policy consistently favors creditors over debtors, asset holders over workers, financial stability over full employment? The Fed's mandate is supposedly maximum employment and price stability. Yet every time inflation rises, even slightly, the response is to raise interest rates, deliberately slowing the economy and increasing unemployment. The pain of fighting inflation is placed squarely on workers who lose jobs, never on bondholders who might accept lower returns. And here's the mechanism that makes it all possible: bonds, government debt, those treasury securities that fund deficit spending. They're held by banks, pension funds, foreign governments, wealthy individuals. These bondholders depend on stable, predictable returns. Too much inflation destroys the value of bonds. Too much deflation makes debts unpayable and crashes the economy. So central banks walk a tightrope, creating enough inflation to devalue government debt and boost asset prices, but not so much that bondholders panic and dump their holdings. This sweet spot, this roughly 2% inflation target, it's the compromise between competing powerful interests. It's not designed for your benefit. You aren't consulted. Your purchasing power is the thing being bargained away in this negotiation between government and capital. And the brilliance of the system is that it happens so slowly, so incrementally, that resistance never coalesces. If the government announced a 2% annual tax on all savings, people would revolt. But 2% inflation? That's just how the economy works. That's normal. That's the cost of progress. The framing makes resistance seem ignorant, almost childish. You can't fight inflation without fighting the entire institutional structure of modern economics. The response to 2008 crystallized this dynamic. When financial institutions faced collapse after gambling on subprime mortgages and complex derivatives, the government and Federal Reserve intervened with trillions in bailouts and money creation. This was sold as necessary to prevent systemic collapse, and perhaps it was. But notice who was saved and who wasn't. Banks got bailouts. Shareholders got rescued. Executives kept their bonuses. Meanwhile, homeowners lost their houses, workers lost their jobs, and the middle class saw a decade of wealth accumulation evaporate. The response was quantitative easing, a euphemism for creating massive amounts of new money to buy government bonds and mortgage securities. This drove interest rates to zero, pushed investors into riskier assets, and inflated the largest asset bubble in human history. Stocks soared to record highs even as median wages stagnated. Billionaires doubled their wealth, while homelessness increased. And all of it was financed through monetary expansion, through inflation that never appeared in consumer prices because it went straight into assets. This is the hidden inflation, the wealth transfer that happens before money ever reaches the real economy. Then COVID arrived, and the playbook repeated at an even larger scale. Lockdowns destroyed small businesses while corporations thrived. Amazon's market value exploded as local retailers died. Stimulus checks provided temporary relief, while trillions flowed to large corporations through loans and programs that were quickly forgiven. The stock market crashed briefly, then rocketed to all-time highs as the Fed promised unlimited money printing. If you owned stocks, if you owned real estate, if you had wealth invested in assets, you became vastly richer during a pandemic. If you worked for wages, if you rented, if you had only your labor to sell, you became poorer in real terms even as nominal wages slightly increased. The wealth gap widened to levels not seen since the Gilded Age, and it was monetary policy that created this divergence. Every dollar printed benefited those who already had dollars to invest. Every round of stimulus found its way into asset prices faster than consumer goods. And when inflation finally appeared in grocery prices and gas stations, the people who created it blamed anyone except themselves. What should terrify you is how comfortable the system has become with this arrangement. There's no serious political movement in America or Europe calling for a return to sound money, for any external constraint on monetary expansion. Both parties, all mainstream economists, they've accepted that central banks should have unlimited power to create money, limited only by their own judgment about inflation. This is an astonishing concentration of power in unelected institutions, power to reshape the economy, to determine winners and losers, to fund government programs without legislative approval. And it's defended as technical, apolitical, necessary. But money creation is perhaps the most political act imaginable. It determines who thrives and who struggles, which investments succeed and which fail, whether savers or debtors benefit. Removing this power from democratic oversight, placing it in the hands of technocrats who rotate between central banks and the financial institutions they regulate. This is oligarchy with academic credentials. The trajectory is clear. Every crisis results in more money creation, more central bank intervention, more inflation. The political pressure is always toward expansion. No politician wins elections by promising austerity and monetary constraint. Every constituency demands spending. The poor need social programs. The middle class needs infrastructure and tax breaks. Corporations need subsidies and bailouts. The military needs funding. How do you satisfy everyone without explicit taxation? Inflation. Print the money, spend it, let the consequences diffuse through the economy over years, by which time new politicians can blame new scapegoers. The system is designed to expand until it can't, until inflation spirals beyond control, until the currency collapses entirely. This isn't speculation. This is the historical pattern. Every fiat currency in history has eventually failed, debased into worthlessness by governments unable to resist the printing press. The dollar has lasted longer than most, protected by America's military and economic dominance, by the dollar's role as global reserve currency. But that protection is eroding. Foreign governments increasingly trade in other currencies, seeking alternatives to dollar dominance. When the dollar loses reserve status, when the world stops accepting unlimited dollar creation, the accumulated inflation will come home with devastating force. And here's what makes sleep difficult. The people in charge know this. They understand that the current system is unsustainable. They know the debt will never be repaid honestly. They know asset prices are detached from any fundamental value. They know that inequality has reached levels incompatible with social stability. But they also know that stopping, admitting failure, restructuring the system, it would require pain that no politician will volunteer for. It would require defaults, bankruptcies, a revaluation of asset prices that would destroy the wealth of the powerful. So instead, they continue each year adding more debt, more monetary expansion, more inflation, hoping they can maintain the illusion long enough to retire before the collapse. This is governance as a Ponzi scheme, each generation paying for the last with increasingly devalued promises to the next. And we, ordinary people trying to build lives and futures, we're the ones who will pay when it ends. But perhaps the most insidious aspect is how completely inflation has been normalized. People talk about inflation-adjusted prices, real versus nominal values, as if it's natural for money to constantly lose value. Imagine if distance changed, if a mile meant something slightly shorter every year, so that a 100-mile journey today would be 102 miles next year using the same roads. It would be absurd, infuriating, impossible to plan anything. Yet we accept this for money, the measuring stick for all economic value. We accept that our savings will be worth less tomorrow, that our wages will buy less next year, that the numbers in our bank accounts mean nothing without knowing the current level of inflation. This is learned helplessness on a societal scale, and it serves those in power perfectly, because people who can't imagine an alternative won't fight for one. The current generation has lived their entire lives under fiat currency and perpetual inflation. They have no memory of stable money, no reference point to understand what's been lost. To them, this is just how money works. Convincing them otherwise requires deprogramming decades of education and experience. So where does this end? History offers few comforting answers. Some fiat currencies collapse in hyperinflation, becoming worthless almost overnight. Weimar Germany, Zimbabwe, Venezuela, the pattern repeats. People pushing wheelbarrows of cash to buy bread. Life savings evaporating into nothing. These collapses are political as much as economic, destroying trust in institutions and often leading to authoritarianism. Other currencies die slowly, maintaining nominal stability through increasingly authoritarian monetary control, capital controls, restrictions on what people can do with their own money. This is the path China follows, and increasingly Western nations too. Negative interest rates, restrictions on cash transactions, talk of central bank digital currencies that would give governments complete surveillance and control over every financial transaction. The endgame of fiat currency might not be collapse, but totalitarian control, where money itself becomes a tool of social engineering, programmable currency that can be turned off or restricted based on government approval of your behavior. And this is sold as progress, as financial innovation, as consumer protection. The alternative, returning to some form of sound money, faces enormous political obstacles. Who would volunteer to shrink government, to admit that decades of promises were lies, that pensions and social programs can't be funded at promise levels, that the debt will be defaulted on one way or another? The pain of transition would be immense, concentrated in the present, while the benefits would be diffuse and long-term. No democracy has ever voted for this kind of austerity voluntarily. It only happens after crisis, after collapse forces recognition that the old system is dead. And even then, the powerful work to restore their advantages under new arrangements. The reset after World War II gave us Bretton Woods, which seemed like sound money but contained the seeds of its own destruction. The reset after Bretton Woods gave us unlimited fiat currency. The next reset, after this system collapses, what will it bring? If history is any guide, an even more centralized, more controlled, more explicitly political monetary system. Each crisis is used to consolidate power, never to distribute it. Yet there are cracks in the facade. Bitcoin and cryptocurrency represent an attempt to create money beyond government control, digital gold that can't be inflated by decree. Whether this succeeds or fails, the fact that millions of people are seeking alternatives to government currency indicates deep distrust in the current system. Inflation itself is waking people up. When grocery prices double, when housing becomes unaffordable, when the gap between official statistics and lived experience becomes too vast to ignore, people start asking questions. Why is this happening? Who benefits? What alternatives exist? These questions are dangerous to the status quo, which depends on complexity and obfuscation to maintain legitimacy. The more people understand how money actually works, how inflation is created, and who it serves, the harder it becomes to maintain the illusion that this is all necessary and natural and for their own good. There's also growing recognition among some economists and policymakers that the current trajectory is unsustainable. Not enough to change course, not yet, but enough to generate discussion about alternatives. Modern monetary theory argues that governments that print their own currency can never go bankrupt, that deficit spending is limited only by inflation, and that we should embrace this reality rather than pretend debt matters. This is honesty about how the system works, even if the proposed solution is more of the same. Others advocate for return to commodity-backed currencies or basket currencies or algorithmic central bank rules that remove human discretion. Each proposal faces immense opposition from those who benefit from the current arrangement, but the conversation itself indicates that intelligent people recognize we're approaching an endpoint. What happens next depends partly on how long the current system can be maintained. Every tool that's been used to suppress inflation in the past, raising interest rates, reducing government spending, accepting recession, these tools become harder to use as debt levels rise. When you owe $30 trillion, even modest interest rates consume enormous portions of the budget. Raising rates risks triggering defaults, not just government default, but cascading failures in corporate debt, student loans, mortgages, all the debt that was affordable at near zero rates but becomes crushing at normal rates. So the most likely path is continued money printing, continued inflation, with periodic crises met by even more expansion. This can continue far longer than seems rational, as long as people accept the dollars being printed, as long as the social fabric holds, as long as alternative systems don't emerge. But every extension of the inevitable makes the eventual reckoning worse. The longer we pretend this is sustainable, the higher the mountain of debt and printed money, the more catastrophic the collapse when it comes. And it's coming. Not tomorrow, maybe not for years, but history is unambiguous about the fate of currencies backed by nothing except political promises. They all fail, every one, without exception. The only question is whether the failure is fast or slow, chaotic or managed, and what rises from the ashes. Your position in this depends heavily on choices you make now. Those who understand inflation's nature can protect themselves, moving wealth into assets that maintain value, acquiring skills that remain valuable regardless of monetary regime, building networks and relationships that survive economic chaos. Those who don't understand, who trust that the system will protect them, who believe inflation is temporary or manageable or someone else's problem. They're the ones who wake up one day to discover their savings are worthless. Their pensions are unfunded promises. Their future has been quietly stolen over decades of seemingly small devaluations that compound into total destruction. So return to the question posed at the beginning. Is inflation a mistake or the plan? The evidence is overwhelming. Inflation isn't an unfortunate accident, a policy error that well-meaning officials are trying to fix. It's the entire point of the modern monetary system. It's how governments fund themselves without the political cost of taxation. It's how debt is silently defaulted on while maintaining the fiction of creditworthiness. It's how wealth is transferred from the powerless to the powerful, from the many to the few, from workers to asset owners. And it's all perfectly legal, conducted in the open, defended by institutions and experts, taught in schools as normal and necessary. The brilliance of inflation as a tool of control is that most of its victims never understand what's happening to them. They feel the squeeze, the growing difficulty of making ends meet, the sense that something is wrong with the economy. But they blame themselves, their choices, their lack of success. They blame immigrants or corporations or foreign competition. They blame anything except the systematic devaluation of money itself. Because understanding that requires seeing through layers of institutional propaganda and accepting that the authorities are lying, not through conspiracy, but through institutional self-interest and ideological blindness. Nixon sweating in that room at Camp David, making a decision that would reshape global economics. He probably didn't fully understand what he was unleashing. He was solving an immediate crisis, stopping a run on American gold reserves, buying time. But the people who came after, the central bankers and treasury officials and academic economists who built the modern system on that foundation, they knew exactly what they were doing. They created a monetary regime that allows unlimited government expansion, that transfers wealth upward, that punishes savers and rewards speculators, that makes the rich richer and the middle class poorer, while maintaining just enough growth and just enough stability to prevent revolution. It's brilliant in a horrifying way. It's elegant. It's monstrous. And it's your entire life, whether you know it or not. What would you have done if you were in their position? If you understood that the debt was unpayable, that gold convertibility was finished, that the only options were collapse or a new system based on faith and force? Would you have admitted failure, accepted depression and default, or would you have changed the rules to maintain power? Tell me in the comments what you think, because this isn't ancient history. This is happening now. This is your paycheck losing value. This is your savings evaporating. This is your future being mortgaged by people who will never face consequences for their choices. And if you want more stories that reveal how power actually works, how the systems we trust are designed to exploit us, then subscribe. Because the next one might just change how you see everything, from the money in your wallet to the promises made by those who claim to serve you. The truth isn't comfortable, but it's the only thing that might set you free.